I wanted to talk about this because the Federal Reserve just held interest rates steady while a faraway war pushed American inflation to a 3-year high. A narrow strip of sea becomes unsafe, oil gets expensive, transport costs rise, and eventually the shock reaches your fuel bill, your groceries, and the price of borrowing. The question is simple. When inflation comes from a war the central bank cannot control, what is the central bank supposed to do? Here is what happened. On June 17th, Kevin Warsh chaired his first policy meeting as head of the Federal Reserve, America's central bank. The committee voted 12-0 to keep its main interest rate range at 3.5% to 3.75%. No cut. No increase. Just a hold. But the hold was not relaxed. In the Fed's new projections, the typical official sees the policy rate ending 2026 around 3.8%, slightly above today's midpoint. 9 of the 18 officials who submitted projections expect at least one increase by year-end, 8 expect no change, and 1 expects a cut. Warsh himself did not submit a forecast. Why did that possibility suddenly appear? Start with the inflation report. Consumer prices in May were 4.2% higher than a year earlier, the hottest annual reading since early 2023. Energy prices were up 23.5%, gasoline was up more than 40%, and energy caused more than 60% of May's monthly increase. That is the visible shock. But there is an important correction here. The Fed does not formally target the Consumer Price Index. It targets personal consumption expenditures inflation, or PCE inflation, at 2% over time. Its June projection put PCE inflation at 3.6% for 2026, up from 2.7% in March. Core PCE, which removes food and energy, was projected at 3.3%. Oil is a major part of the problem, but it is not the whole problem. So where did the oil shock come from? The Strait of Hormuz is the narrow sea route between Iran and Oman through which roughly 1/5 of the world's petroleum liquids normally pass. Military action began in late February. Shipping through the strait became extremely limited, and millions of barrels a day of regional production were shut in. Brent crude averaged about $107 a barrel in May. That is what economists call a supply shock. Prices rise not because people suddenly want more fuel, but because less fuel can reach the market. Raising interest rates can reduce spending and make mortgages, car loans, and business investment more expensive. But it cannot escort a tanker through Hormuz, repair damaged facilities, or negotiate a ceasefire. Then why not ignore the energy spike and wait for it to fade? Because temporary shocks do not always stay temporary. Higher fuel costs raise trucking, shipping, air travel, plastics, fertilizer, and factory expenses. If households and companies start expecting inflation to remain high, a one-off energy shock can spread into the rest of the economy. The latest data show both sides of that argument. Core consumer inflation was 2.9% in May, well below the 4.2% headline number, but still above a comfortable 2% pace. Producer prices, which track costs earlier in the supply chain, were 6.5% higher than a year earlier. Meanwhile, first quarter economic growth was revised down to an annual rate of 1.6%. The Fed is looking at hotter prices and softer growth at the same time. You can already see the trap. Increase rates too quickly, and the Fed could weaken an economy that is already slowing without creating a single extra barrel of oil. Do nothing for too long, and the energy shock could leak into wages, services, and expectations. Waiting for evidence is sensible. The dangerous part is that waiting can look exactly like hesitation. There was also a major change in how Warsh communicated. The policy statement was under 100 words, much shorter than recent statements, and it removed the usual forward guidance, the language central banks used to hint at future moves. Warsh also declined to place his own mark on the projection chart known as the dot plot. Is that only a change in style? I do not think so. It gives the Fed more room to react if oil falls quickly, but it also makes markets less certain about what comes next. Warsh is trying to sound firm on inflation while keeping his own options open. And the timing matters. Just before the meeting, the United States and Iran signed an interim memorandum intended to extend the ceasefire and reopen Hormuz, while they negotiate a broader settlement. Oil prices fell sharply, dropping below $80 a barrel by June 18th. But a signed memorandum is not the same thing as fully restored shipping. Tankers, insurers, ports, and producers still need time and confidence before normal flows return. So who benefits from the Fed holding? Borrowers avoid an immediate increase in financing costs. The administration avoids a fresh rate shock, and the Fed preserves room to move later. Who remains exposed? Households still face prices already pushed through the system. Companies still carry higher freight and input costs. Energy importing economies still have less protection if oil jumps again. This is where the story becomes global. More than 80% of countries import more oil than they export. Richer governments can sometimes cushion households with tax relief, reserves, or subsidies. Emerging economies usually have less room. In Malaysia, inflation reached 1.9% in April, with transport prices up 4.1% from a year earlier. The number is modest compared with the United States, but the transmission line is the same: global oil, local transport, packaging, freight, and food costs. What happens next? My read is that the Fed stays on hold through the summer and probably through September. If Hormuz reopens steadily and oil remains well below its May average, headline inflation should cool before the Fed needs to act. I think a year-end increase is possible, but not automatic. The committee will want proof that the shock is spreading beyond energy. The key signal is not one day's oil price. It is whether core PCE inflation, service prices, and longer-term inflation expectations move higher together. If they do, the case for an increase becomes much stronger even if growth slows. If they do not, the Fed can keep waiting while the energy effect gradually washes out. Here is what I actually think. Holding rates was the least bad choice. Increasing them immediately would have looked tough, but it would have attacked the damage rather than the cause. At the same time, Warsh's shorter statement and refusal to publish his own rate path make the Fed harder to read at exactly the moment the world wants clarity. That may be deliberate, but uncertainty is not free. The bigger lesson is that central banks can control demand, not geography. They can make money more expensive, but they cannot make a strait safer. In 2026, the path of interest rates may depend as much on tankers moving through Hormuz as on shoppers walking through American stores. Do you think the Fed was right to wait, Or should it have responded more aggressively to the inflation spike? Tell me what you think in the comments. If this video was useful, please like, share, and subscribe. See you in the next one.